Good morning, everyone. I'm John Cogan, the CEO of Performative, the online community for corporate finance, accounting, treasury, and related professionals. I'd like to thank everyone this morning for coming to our webinar entitled Revenue Recognition, Regulatory Update, and Best Practices. As a four-time CFO myself, I know that revenue recognition is near and dear to the heart of pretty much every company. And there are a lot of interesting ins and outs when it comes to revenue recognition. So today what we hope to do is give folks a quick grounding and update in some of the most far-reaching RevRec regs out there. That's 97.2 and then 081 and 093, which are the two most recent EITFs that go by about 3 or 4 names each. And this will cover software revenue recognition, multi-element arrangements, and then what we'll also spend a little bit of time on is going through some of the current activity that's happening at the FASB and the IASB around things that are coming down the pike, because there are more changes coming. Obviously, we all know about IFRS. Some are out there on the horizon, and revenue recognition is a hot topic regardless of whether you're in the U.S. Under our accounting standards or anywhere else. So there is a lot going on, and we've got some great speakers this morning to help us sort of make sense of this, and also to tell us a little bit about how some companies are implementing revenue recognition. Quick note, I'd like to thank Frank Rimmerman and Co. and NetSuite for helping us make this event possible and free for everyone today. We love bringing great advice and insights to our user base, and those two companies are really on top of what's going on around revenue recognition, and we thank them for their participation. Quick note on today's agenda. First, we'll hear brief presentations from 2 speakers, and then we will move to a panel discussion where we will spend the remainder of our time. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we will do our level best. And typically, if we miss on getting to some questions, we'll be able to follow up afterwards and get you answers to the best of our ability and to the best of our partners' ability. We don't always have the answers, but sometimes we'll reach out to partners to help with that. So please feel free to hammer us with questions at any time. We look forward to getting that, and we'll do our best to address them. A couple quick pieces of housekeeping. We will send out soft copies of this presentation to all attendees. Actually, I should modify that. We send out a link. We put soft copies of the presentation up on our website where they're freely available. You can grab them anytime. So feel free to do that, and you should get that email with the link typically within 24 hours. We are offering CPE credit for today's event. Most of you, I can see from our registration list, have already signed up. When you registered, you clicked the little box that said, I want CPE credits. And in that case, you'll get a certificate emailed to you. If you neglected to do that, or if you aren't certain whether you did that, take a look in the chat box in your GoToWebinar control panel, and you'll see the email for Tanya Walsh. She is our CPE manager at Performative, and simply drop her a quick email. She will make sure that you get your credit for today's event. So we hopefully can make that nice and easy for you. Let's see, I think that's all of the housekeeping. Just one last encouragement to go ahead and ask questions as we go. Now, a quick welcome to Performative. For some of you in the audience, today is your first experience with Performative, and we thank you for coming aboard. Performative is the largest and fastest growing online resource for senior level corporate finance, accounting, and treasury professionals. We are a completely ad-free, noise-free, and free community of well over 250,000 CFOs, controllers, treasurers, and others. Very simply, it's a place where folks come online, they find peers, they find subject matter experts, and all sorts of information that we bring to bear. So it's a great resource, and as a longtime CFO, it's been something of a dream of mine to be able to have this kind of online community. So welcome to it today, and feel free to check us out online at performative.com. quick note on learning objectives for today. We'd love for you to come away with this knowing more about 97.2, 081, 093, how they affect your company, and what you might need to do to prepare for implementation of these at your company. So we certainly hope you come away knowing more than you knew when you came and having some useful, actionable information. So with that, let me go ahead and introduce our first speaker today, Tim Perotti, who is a partner at Frank Rimerman & Co. Tim is an assurance and advisory partner working out of Rimerman San Francisco and Palo Alto offices. His expertise includes revenue recognition, equity accounting, M&A transactions. He has 15 years of experience providing technical accounting, financial reporting, and advisory services to business in professional services, manufacturing, distribution, software, and high-tech industries. He also has extensive experience working with privately held pre-IPO venture-backed companies, as well as companies with international operations and reporting requirements. So with that, Tim, I'm going to hand it over to you. Take it away.
Thank you, John. And thanks for everyone for attending this webinar. When John contacted me and said, hey, I'd like you to spend a little bit of time on software revenue recognition, the new multiple element rules, and maybe touch on what's coming down the pipe from a revenue recognition perspective, and, oh, by the way, we want you to do it in 20 minutes. I said, yeah, that's not a problem. I always appreciate, too, the way that Performative runs these seminars, too, keeping people on task and on time. And with that, to the extent that anyone wants to dig a little deeper, either through the Q&A session at the end, or if you want to follow up after this webinar with me, my contact information is listed through Performative as well. So thank you very much. Let's see here. As we move down, the points of discussion, what I wanted to do was spend just a few minutes touching on the general revenue recognition and software revenue recognition rules. Then move into the new multiple element arrangement rules. So this is the originally issued as EITF 081 and 093, and then post-codification, the ASU 2009, 13, and 14. And then spend a few minutes at the end, time permitting, we'll discuss a little more, a little less, but the proposed new FASB IASB guidance as it's coming down the pipe, just because that is in exposure draft with the revised exposure draft to come shortly. So that just, again, a touch point here on the general revenue recognition criteria. So again, as it relates to any sort of arrangement, you must have persuasive evidence of arrangement. So that's typically a contract, a purchase order, something along those lines. Delivery has to have occurred. Fees fixed or determinable, and collectability assured. So you assume you're going to be paid for your services or delivery of goods. And then as we move on to the software piece, a lot of the emphasis of SOP 97.2 when it was introduced had to do with the concept of multiple element arrangements. And so to the extent that you've got the concept of vendor-specific objective evidence, that was first broached in SOP 97.2 and further clarified in EITF 0021. And we'll touch on some of the new references, if you will, post-codification here in a little bit. So as we move the software revenue recognition guidance, so essentially the literature as it relates now in Topic 985, originally 97, SOP 97.2, applies to licensing, leasing, or marketing of computer software. So essentially it applies when the software is essential to the functionality or not incidental to the product or service being delivered. So these are the wonderful examples that we walked through when we were first getting an understanding of the software revenue recognition rules. So the examples being an automobile or a large test system that includes software, but the cost of putting the software in or the functionality from a customer's perspective is incidental to the product they're buying. So in those situations, the software revenue recognition guidance did not apply. So again, we're looking at situations where the software is essential to the functionality. So again, one of the key concepts coming out of SOP 97.2 dealt mostly with how to handle multiple element arrangements. So as you see on the screen here, I've got just some typical examples of the elements that are usually found within software arrangements. So if you look partway down the screen, the most common example would be a company that licenses software, also has a degree of PCS, be it the delivery of any upgrades and enhancements when available. So again, these are unspecified upgrades or enhancements when they become available. And the concept of professional services. So we'll touch on a little bit later in terms of how those are addressed in some specific situations. But I think the key concept, again, is looking for this idea of vendor-specific objective evidence. So the concept of fair value as it relates to any elements that are not delivered at the outset of the arrangement. So be it an enterprise license that's delivered, and then you have the follow-on professional services and any PCS. So being able to identify fair value for those undelivered elements at the inception of the agreement. And if you can't, then you need to defer the entire agreement over the period of time. So for example, if you have VSOE on your PCS, but not on your professional services, then you need to defer the license over that professional services period. If you have VSOE on both your PCS and your professional services, then you can recognize your license up front and then recognize both the professional services and the PCS arrangement according to their terms as those services are provided. So what I wanted to do here was spend a couple minutes on what I call the common questions or common issues that come up within our audit practice. So the first being, and I think to the extent that anyone wants to have a discussion or ask some questions on the specific parts of 97.2, again, we can do that in the Q&A, but at the same time, I know a lot of the general rules have been hit in great detail, so spending a little bit more time walking through just some real-world examples, if you will. So the first being the situation where software is sold with hosting services. So there you go through a couple different decision points, if you will. So the first is, does the software revenue recognition guidance even apply? So this is the idea, and I'll speak in pre-codification references, if you will. So is software, is SOP 97.2 going to apply, or EITF 003, which is your subscription accounting? So as you're taking a look at the hosting arrangement, to the extent that the customer can go ahead and take the software in-house as the literature defines without incurring significant penalty, further defined to be incurring a large amount of cost to go ahead and install and run that software in-house. So to the extent that they have the ability to do that without incurring a significant penalty, then the software revenue recognition rules would apply. So 97.2 rules do apply. To the extent that they can't, and the software needs to be hosted on the vendor's system, and there's not an ability for the customer to take it in-house, then former EITF 003, essentially subscription accounting, applies. So then when you look at it a bit further, to the extent you're under the 97.2 rules, if you have VSOE, so if you have fair value on your hosting services, you're able to recognize the license piece up front. And if you don't have VSOE on your hosting services, then you have to recognize the license and hosting together over the term of the arrangement. Where this gets a little different is that if you're outside of the software revenue recognition guidance, so under the old subscription accounting 003, and to the extent that the concept of VSOE isn't going to come into play. So essentially, the entire deal has to be recognized, the license and the hosting piece, over the subscription period. So again, a little nuance of VSOE as it applies to 97.2 as opposed to the old subscription accounting. The next item here on the screen is the specified versus unspecified updates and enhancements and the impact on revenue recognition. So the idea there is, to the extent at the inception of an agreement, you have a specified deliverable. So you've agreed in that arrangement to either deliver the next version that's not available at this point, or some other number of user licenses or something along those lines. That becomes a separate element to your arrangement. And as it's not delivered at the outset when you deliver the license, you need to have VSOE or fair value on that element. To the extent you do not, then you have to defer that license and defer the arrangement until you can go ahead and either obtain VSOE on those specified deliverables or until you go ahead and deliver them. And what's more common is to have unspecified updates and enhancements, which are part of your post-contract customer support, so your PCS arrangement. The idea being there that the arrangement with the customer is, to the extent that you come up with something, updates, enhancements, or otherwise, that those will be delivered as part of the PCS arrangement. In those situations, those, as they're unspecified at the onset of the arrangement, are part of your PCS agreement. So to the extent you have VSOE on the PCS arrangement, then that plays in, as we talked about a little earlier, in terms of being able to carve out and recognize the license piece a bit earlier. The last point I had on here has to do with the vendor-specific objective evidence of PCS and professional services and how that impacts your revenue recognition. So again, the methods to testing from an internal perspective are your bell-shaped curve and your stated renewal rate. So the idea being in the bell-shaped curve analysis that you have the situation where customers are renewing their PCS on an annual basis. And to the extent you aggregate those renewals, which are standalone sales of PCS, if you can get a clustering, and again, there's the typical guidance of being within a range 15% of the median either side, at least 80% of the time. But if you can maintain that consistent range of PCS, then you have VSOE on the PCS, and that will apply to your subsequent agreements where you're bundling the license. And professional services is a little more difficult, if you will, in practice to test. But essentially, if the professional services are essential to the functionality of the software license, then you need to defer the license over the service period. So as you're providing the implementation or customization services, if they're essential to the functionality, you need to go ahead and defer and recognize defer the license piece and recognize it as you're providing the professional services. And then the last piece there, when you're looking towards VSOE on the professional services, assuming it's not essential to the functionality, so you can carve out to the extent you have VSOE, typically you're going to look at some sort of hourly or daily rate that's either consistently applied or sold on a standalone basis to get VSOE. So now I want to touch for a couple minutes here on the revenue recognition with multiple deliverables. So this is the guidance that came out at the end of 2009 that is in effect beginning calendar years 2011 for most companies. Again, several companies being your Apple, Cisco, NetSuite, early adopted. And we'll hear a little bit more about how that process went with NetSuite a little later here in the presentation. So the scope of ASU 2009-13, originally 081, so it does not trump other industry-specific guidance. So essentially, if you're applying the software revenue recognition rules under former 97.2, under what's now topic 985-605, the new EITF would not apply. So this is as the 081 rules came for separating multiple element arrangements and superseding former EITF 0021. Essentially, if you're under the software rules, it would not apply. So the criteria is listed here on this slide that should be popping up. There it is. You need to have the ability to separate excuse me, different elements. So you need to have objective and reliable evidence. So essentially, in order to account for items separately, they must be of value to the customer on a standalone basis. Which either means they're sold separately or they must be able to be resold by the customer. So 081 or ASU 2009-13 also introduced the concept of estimated selling price and the concept in terms of how to allocate that selling price. So here, really quickly on the screen, you'll see a bit of a side-by-side comparison of the old multiple element rules versus what came out in 081. And again, looking at the criteria for separation, and then again, the allocation method. So if you look down at the bottom, really the key difference being under the allocation method is that the residual method. So being if you didn't have fair value or didn't have VSOE, the ability to just recognize the entire deal over your PCS term, as an example, would not be allowable, is not allowable under the new rules. Now, the other thing that 081 did was establish the hierarchy of being able to establish fair value. So you have the concept of VSOE and then third-party evidence, which are currently in play, and then the new concept of estimated selling price being introduced. So here, really quickly, we've got a listing of VSOE and third-party evidence. So essentially, VSOE, the standalone value when sold separately. Third-party evidence coming in when you have good visibility into your competitors' products. And then the concept of estimated selling price, which essentially, if to have estimated selling price, the item must be resaleable. And the reason is because if it is sold separately, or if you have VSOE or third-party evidence, then you wouldn't need to take these next steps to move to estimated selling price. The key point here would look at, when looking at this from an implementation standpoint, is that market conditions do apply to as you're going ahead and developing your estimated selling price, and that's something that companies, as they're implementing the new guidance, have struggled with a bit. So here on the slide, what we're looking at are just some of the factors that companies go through when they're determining their estimated selling price. So to a large degree, you've got your internal factors and your external factors. As companies go through this process, and again, these should be bullet points here on the left, but the ones I would highlight for our clients that have early adopted or companies that are doing it now is that on the left here, pricing practices, looking at companies' cost and margin, and being able to gain that information. And then to the right, customer demand is also a key. So that as companies go ahead and implement the new guidance, what they do is spending a bit of time going through the systems and their approach to get the information on bundled sales in order to go ahead and improve their estimated selling price. So essentially, it's a continuous effort of gathering information and seeing how that applies to your revenue recognition policy. And then the next slide, this is the concept that was introduced in EITF 09-3. So essentially what this did is, to the extent that you had software included in a hardware product, to the extent that it could, the product contains both software and non-software that function together to deliver the product's essential functionality, you would carve that out of the software revenue recognition guidance and apply the new guidance under 081. And I won't read through all of these, but as you go ahead and evaluate the essential functionality to determine whether or not the software is essential to the functionality and if the products work together to deliver the expected functionality on the customer standpoint, these are some of the items that you would go ahead and walk through to do that evaluation. And then I have a couple minutes left here. So what I wanted to do was spend a few minutes talking through what's coming down the pipe. So right now, you see revenue recognition rules moving in the idea of convergence with international standards and moving more towards a principle rather than rules-based. So as I've been in the profession the last 18 years, rules have been the order of the day. If you were to anyone who's been practicing a bit longer than that, you remember a time when principles were more of the order of the day in terms of how rules were applied. The other thing that's common is applying broad concepts across all industries, and as opposed to having the large amounts of guidance that U.S. GAAP has, over 500 pieces of different rules and regulations around revenue recognition, applying more of a principles base. So contrary to that, the international standards have 2 pieces of literature. And lastly here, we talked about a little bit in the multiple element rules, this emphasis now on fair value over cost. So this is an important concept moving forward. So where we stand now, there's the joint FASB IASB revenue recognition project that's in place. So essentially, this is to clarify RevRec rules and make sure that there's a consistent policy applied between the FASB and the IASB. So again, we talked about how much literature there is from a GAAP perspective as opposed to IFRS, the international standards. And the new revenue recognition rules are going to go ahead and supersede all of the FASB as well as international, the IAS guidance. And it's going to apply to all contracts with the exception of lease contracts, insurance contracts, guarantees, and then there are some other points that are scoped out as well. And then as I'm running to the end of my time here, essentially as we go through this, the new rules as they play out, main principle, so recognizing revenue upon the transfer of goods and services, basically looking to apply consideration based on an estimate of fair value as it relates to those goods or services delivered. And as you walk through that process, you're going to have 5 steps that you apply. Essentially, your identification of the contract, so there are 2 parties, enforceable rights and obligations, identification of the performance obligations, so that there's a promise to transfer a good or service to a customer, determination of the transaction price, so making sure that there is consideration and it's known at the onset of the agreement, and then allocation of the transaction price to performance obligations. So this is the concept of multiple elements, and you're going to see something similar to what we talked about with the multiple element rules as they're coming into play now, the concept of VSOE, third-party evidence, and estimated selling price. The one difference being that the residual method will come back into play under this new common standard, at least now as it exists in the exposure draft. And then the recognition of revenue when the satisfaction of each obligation. So as you've identified each of the obligations, then you go ahead and recognize revenue according to each of those identified elements within the arrangement. And then as we wrap up here, just a listing of some of the key differences from existing GAAP standards. So again, looking at how you handle contract costs, uncertain consideration, credit risk and bad risk, and allocation of the transaction price. So there are some differences or not. And then you look at warranties. So to the extent that warranties are purchased separately, that's another element to your arrangement. If they're not, then they're included in your analysis of the initial arrangement. So that's the last piece that I had. The one thing with regards to the exposure draft, the first exposure draft did come out last year, and the revised exposure draft is set to be released before the end of Q3, which is coming up quickly. So with that, and I went a couple minutes over, my apologies, but thank you for your time, and look forward to connecting here in the Q&A session. Thanks, John.
Great, thanks, Tim. I know that's not easy. We don't give a lot of time to go through an awful lot of material, and I know that also can be tough on the folks listening. So hopefully that was a good overview. I thought it really covered the main topics well. Before we introduce our next speaker, just a couple items. I see a number of questions piling up on a couple themes, so I'll address those real quickly. People are asking about the soft copies of today's presentation. We will post today's presentation on our website. That will happen probably during this weekend, be available next Monday. We will send out an email with a link to today's presentation, so you can all come and grab it. It's free. We just, instead of sending out gigabytes of email, we just post it on our website for you. I've got a number of questions about CPE credits. If you look in the chat box on your GoToWebinar control panel, you'll see the email address for Tanya Walsh. If you have any questions around CPE credit, just go ahead and email Tanya, and she will make sure you get your CPE credit certificate. And lastly, as we continue to go, if you have any questions at all about revenue recognition, whether it's the regulations or implementation considerations, please go right ahead and ask the questions via the question area in your GoToWebinar control panel. And with that said, let's go ahead and move on to our next speaker, Eileen Tobias. Eileen is a Director of Financial Planning and Analysis at NetSuite. Eileen led the process for setting ESPs, the estimated selling prices that Tim referred to earlier, during NetSuite's implementation of EITF 08-1. Prior to joining NetSuite in 2005, she worked at a number of publicly traded companies in the San Francisco Bay Area, including Brocade, BEA, and Hewlett-Packard. Eileen has extensive experience in FP&A, general accounting, and cost accounting functions. And with that, Eileen, I'll go ahead and turn it over to you.
Thank you, John. Thank you, Tim. Good morning, everyone. Today I'm going to be giving you an inside look at the revenue recognition process here at NetSuite. So to begin, I'd like to give you a brief background on NetSuite because some of you may not be familiar with NetSuite. I'm not sure. There we go. So NetSuite is a publicly traded software company. We were founded in 1998. We've been public since 2007. We offer a cloud-based ERP suite that includes financials, HRIS, CRM, e-commerce, and a host of other functionality. Our customers subscribe to our product and access it via the web. We are currently tracking to do about $230 million in revenue this year, and we have more than 7,000 customers around the world. And it's important to note that internally, we actually use the NetSuite system to run our own business. Now, before I dive into our actual revenue recognition process, I wanted to give a brief background on what our sales order and revenue environment is like. So in a particular month, we process more than 1,200 sales orders. So we have a fair amount of volume and complexity to our business. These orders come through in a variety of different, what we refer to as classes. So we have new orders that we do with new customers that we've acquired in the period, and then we also do orders that go out to existing customers, whether they're for additional functionality, which we call upsell, or renewals of existing orders. We process these orders in a variety of different currencies and in a variety of different locations. So again, a fair amount of complexity in terms of volume, currency, and location. We basically sell 3 different types of products. We have our suite, which we refer to as subscription, and again, our customers subscribe to that and access it via the web. They don't take delivery of the software. Our customers also have the opportunity to purchase customer support contracts. And we also sell professional services, which generally falls into 2 different types of professional services, whether it's implementation to get our system up and running, or it might be training, which is offered either in group or in customized small group settings. It's important to note that just as Tim was outlining 0801, we adopted 0801 in 2010. So we adopted partway through the year, and it was effective as of January 1st. So, so all of our revenues that were reported for fiscal year 2010 were governed under 0801. We are not able to establish VSOE or TPE, so we utilize estimated selling prices for all of our items. Under 0801, our subscription revenue is amortized over the term of the customer contract, and our professional services revenue is recognized on a % complete basis. And you'll see when you look at our financials, when you looked at our financials before the implementation of 0801, you would have seen our revenue reported simply as one line as a single unit of accounting, and then now we're able to provide insight to both internal management and the external world into the split of our revenue between subscription and professional services. Okay, now that we've talked about the background of NetSuite and our revenue recognition environment, I wanted to walk you through the overall revenue recognition process here. So it all begins with the sales order process. And here at NetSuite, our sales reps actually initiate the sales order process. They input the orders into the system. They go through sales management for approval, and then on to finance for review and final approval. Once the orders have met all the requirements and are approved, they're run through the EITF 0801 allocation process directly in our system. We have functionality that has automated this process. So every order is evaluated to see whether an allocation is needed under 0801 by looking at the relative ESPs of each of the items. And the functionality also incorporates any limitations of contingent revenue. So once the allocation is done, our finance team then creates the revenue recognition schedules, which are generated from invoices that come directly from the sales orders. And the revenue recognition schedules are set up for the current period and then for any future periods that are relevant based on the contract term. And then these revenue recognition schedules are stored in our system and then posted to the general ledger via journal entries. So we close revenue each month. Each month after we've closed, we do a deep analysis on revenue and make sure that we are comfortable that the results are accurate and reflect what they should for revenue results. And then obviously on a quarterly basis, we report our revenue externally to the outside world. Throughout the course of the fiscal year, we're able to evaluate our sales order activity and see whether we have any requirements to adjust or put in place any new estimated selling prices. And then finally, the last step that we see in the revenue recognition process is the revenue forecasting process. And I'll touch on that more in a little bit later in more detail. But basically, we're able to utilize revenue recognition schedules and renewal schedules in our system to form the foundation of a customer-level revenue forecast that's dynamic and real-time, and that we update on an ongoing basis, at least monthly, and sometimes more frequently than that. And we're able to manage this entire end-to-end revenue recognition process on our integrated CRM and ERP platform. So just want to touch on a few of the benefits that we see from our integrated ERP and CRM platform. One of the nice things about our environment is that we're able to trace through all the transactions seamlessly within the same system. So we can go to a customer record and we can see all the transactions that have taken place for a particular customer throughout the entire life cycle of that customer. We can see all the sales orders, and we can see how that sales order then goes to the invoicing stage, and then revenue recognition schedules, and then onto journal entries, and then finally the postings to our general ledger. And because our system integrates CRM and ERP functionality, we don't really have to spend a lot of time and resources on multiple reconciliations between multiple systems, since these are both contained within the same system. And then since our revenue recognition module posts directly to our general ledger, again, we don't have to spend a lot of time or resource on reconciling the RevRec module and the general ledger. And then finally, our system is real-time, so we're able to see any real-time changes to revenue based on new orders that have been processed. And we're able to do research and reporting and forecasting with a fairly small team, all in the same database. Now I wanted to walk you through our sales order management process here at NetSuite, take a little bit of a deeper dive into this area. So as I mentioned earlier, our sales order process is initiated by our sales team. And once those orders have been approved by sales management, they move on to the finance queue for review and approval. And one of the things that we've done over the past several years is that we've built out a team in Manila in the Philippines. And so we have a team of CPAs there who do all of our sales order review and processing. So once the orders go from sales, they go to finance, and this team in Manila does the review, does the provisioning, and does the invoicing for all of our customers. And what's great is that we've been able to have a high level of retention there. This team has all been trained to do the same type of sales order processing. They're all in the same place. They all follow the same procedures. So we've been able to achieve a very high level of consistency in our revenue processing functionality. And then we've also implemented a system whereby each month we do a quality assurance process on every order. So our team in Manila, after they process all the orders, they actually do a QA process on every single order. They have a standard checklist that they go through, and they just make sure that the orders have met all of our criteria, all of the fields have been populated, that everything ties back to the estimates, that basically everything in the order is capturing what we want it to capture, and that we don't have any subsequent revenue recognition errors. So with this trained team in Manila with a high level of retention, all of them using the same standard procedures, and the QA process that we follow each month, we feel like we're able to achieve a high level of confidence in our monthly revenue recognition results. So next I wanted to show you a sample of a QA checklist that we have within NetSuite. So you can see here we have an order, and in the center of the screen you can see that there are a variety of fields that we're evaluating on the order. So we're looking at the amounts, the sales order dates, the class, the revenue recognition dates, any required sales tax or VAT issues depending on the jurisdiction. And so in this case, this particular order passed all of the QA checkpoints. These QA checklists are saved in our system, and so they're attached to every order. And our finance management team is able to refer back to these. We can do searching and reporting on these QA results. And so we're able to just ensure, like I said, ensure that our revenue is correct and that we have a high level of confidence in the final results. We're also able to use these QA checklists to identify areas where perhaps our sales team or our finance team needs additional training. Perhaps there's a consistent error that we're seeing over and over again, and then that will point out to the fact that we need to do some additional training. So we've really gotten a lot of efficiency and been able to improve our revenue recognition processes from this QA process. So next, wanted to touch on a couple of benefits that we've experienced from using a cloud-based ERP. As I mentioned, we have a large portion of our team offshored in Manila. So we also have a distributed sales force around the world. We have reps in a number of different countries. And so all of us are able to take advantage of the same system, the same database in a real-time environment, and we're able to access it at any time via the web. So next I wanted to go into a little more detail about our experiences with adopting 0801. As I mentioned before, our subscription and professional services revenues are now broken into separate elements on the face of our financials. We take subscription revenue over the customer contract period, and the professional services revenue is taken on a separate schedule based on % complete. And not only do we report revenue under these two buckets of subscription and professional services, but we also break out our cost of revenue on our financials between these two buckets, which provides some additional insight both internally and externally into the profitability and just the overall cost of our professional services organization. And then one of the things that we had to consider last year, which was our year of adoption, we had to report our results both under 0801 and then under our prior revenue recognition methodology, which was 0021. So during the implementation and then the ongoing support of these new revenue recognition rules, we've utilized the NetSuite system. So when we were doing the initial adoption and implementation, we were able to pull a large amount of historical sales order data straight from NetSuite, and we were able to take the sales order data by item and look at discount behavior and average selling price. We were able to do a variety of different slices of the data by currency, location, customer size, et cetera, to determine whether we needed to do any stratification with our estimated selling prices. I mentioned previously, our RevRec module has the ability to automate the 0801 allocation process, so we have been able to take advantage of that, which again, in an environment where you're processing 1,200 or more orders each month, we find this to be a great benefit. There's really no way that we could manage the allocation process for all of those orders offline in a manual Excel spreadsheet. And then finally, now that we've actually adopted and we're simply running under 0801, we utilize a variety of features within the system to monitor the ongoing sales order activity and see whether we need to do any adjustments to our estimated selling prices. So here, this is an example of a search that we might look at on an ongoing basis. You can see here we're able to view go actually down to the line items of particular items that we've sold, and we can look at the class and the currency and the quantity and what we've sold it for, and then we could do some further analysis to see whether we need to make any adjustments to our estimated selling prices. There could be an item where we've either increased or decreased the discount, and so that might inform our estimated selling prices, or perhaps we started to sell it more to a different type of customer or a different geography. So again, we're able to take advantage of the ability to pull historical data very easily for a large period of time, or we can also set up alerts that will let us know when transactions fall outside of a certain set of parameters. So next I wanted to touch on some controls that we've put in place that govern our general revenue recognition. So what we've done is we have put in automatic limits within our system that if an order exceeds a certain dollar amount, it automatically goes into deferred revenue. For the orders that fall below that threshold, they simply go through the normal sales order process, invoicing and revenue recognition that I talked about before. But for these larger orders, we want to make sure we review those and just make sure that there aren't any complexities or any other issues that might impact revenue recognition. So these orders are automatically deferred, and then twice a month our accounting team gets together with the revenue accountants and then senior finance management, and they go through these orders that are on deferred revenue recognition, do the analysis, make any determination of whether these orders need to stay on deferred revenue for an extended period or whether we are able to just move forward with our standard revenue recognition process. So we're able to also take advantage of the search functionality in our system, and we're able to, at any time, search and see which orders are on what we call DRR, or delayed revenue recognition. And this ensures that we haven't missed any revenue or haven't left something on deferred revenue that we didn't intend to. And then we're also able to enter what we call cases within the system that are automatically subject to workflow and go through from the accountant level to finance management, and we're able to manage and research any issues. And then another thing that we do each month is we have a mid-month metrics review. So we go through all the orders that we've processed, what the volume looks like, any issues that we've identified, anything that pertains to revenue. And again, we see if there are any ongoing recurring errors or issues that might require more training back to the sales force or to our team in Manila. I know I'm getting short on time, so the last topic that I wanted to touch on was the revenue forecasting process. So one of the things that we're able to do quite easily from the NetSuite system is we're able to build out a revenue forecast from all of the existing revenue recognition schedules from all existing customers. And we really find this to be a great advantage to our revenue forecasting process. Basically, we're able to build a revenue forecast down to the customer level. Like I mentioned at the start of the presentation, we have more than 7,000 customers. So to be able to literally forecast at that level sounds quite complicated and difficult, but we're able to do that using the functionality within NetSuite, where we can pull down all of the revenue recognition schedules for future periods for any existing customers. And then what we do is, on top of that, we layer in our assumptions for new bookings for new customers and upsells to existing customers. And with this process, we're able to do this at least monthly. Sometimes we do it more frequently than that. Our system is real time, so anytime we book new orders or process any credits or anything else that might affect revenue, we have the ability to refresh the forecast and give updates to our senior management on how the future outlook looks. This is an example of this revenue forecast report that I referenced. Here you can see by customer, we can actually look at the revenue that's forecasted out in future periods by month, and we can actually get even down to the level of a particular invoice. So we're able to get an incredible amount of visibility into our future revenue stream by running reports from our ERP system. And then to wrap it up, here's an overview and a summary of what's worked for us here at NetSuite. We feel like we have very tight integration between the sales organization and the finance organization, both in terms of the amount of communication between the two teams, and then also in terms of the way we've integrated the CRM and the financial aspects of our system. We've been able to implement a variety of review and control processes in the system, so they're automatic. We don't have to think about doing them. They just happen on a monthly basis and help contribute to the high level of confidence in our revenue results. We've been able to be very successful with building out a distributed finance team. Like I mentioned, we have folks in Manila and folks here in San Mateo. And then lastly, we're able to take advantage of the latest functionality and the latest upgrades to our system seamlessly as they're put out in the system throughout the course of the year. And with that, I'll turn it back over to John, I guess, for the Q&A.
Wonderful. Thank you very much, Eileen. That's extremely helpful insight from someone who's been implementing this, the new regs for quite a while and at a publicly traded company, so I'm sure you've seen an awful lot of the issues that can be seen on that front. Now we have about 8 minutes to handle a handful of questions here. We've got quite a few. I would say if you still have any questions, feel free to get them out here right now. And if we can't get to them during this Q&A session, we'll do our level best to follow up afterwards and see if we can't get you an answer. Let's see. Why don't we start with a question for Tim here, which is around sort of how you handle RevRec in the new, I think, 081 regimen. How would an extended hardware warranty be handled in a bundled arrangement, Tim?
Well, I think it depends. So to the extent that if you have a simple pass-through hardware warranty that you have with the arrangement, then it's a simple accrual method. So to the extent that you've got some expected amounts that you'd have to pay either for part replacement or for labor, then you'd accrue for that amount. To the extent that you're offering something beyond that, so if it's a year warranty, for example, or if it's something even longer than that, that isn't necessarily a pass-through from another entity, then it could become an element, a separate element to the arrangement. I have not seen that often, though, where it would be a separate element in the arrangement. You need to be able to assign fair value to it or have a revenue recognition impact from a typical hardware warranty. I guess it's possible, especially if you're the manufacturer of that product. But I'd say the majority of the time it's simply handled as an accrual to the extent that you've got, again, the labor and the hardware components that you'd have to replace.
Yeah. Great. Thank you for that. Another question, we'll toss this one to Eileen first, but then Tim, I want to come back to you. It seems like these new requirements, especially under 081, require a lot of communication and cooperation amongst non-finance and accounting organization at a company. Is that true? Have you seen that, Eileen? And how do you guys manage to maintain enough communication with the other groups so that things run smoothly?
Yeah, that's a good question. Absolutely. We have seen that the implementation of 0801 and then the ongoing business under those rules does require a lot of discussion between finance and other organizations within the company. So we do find that, for example, we have seen, I would say, the most significant impact on our professional services organization. Prior to the implementation of 0801, we pretty much took all of our revenue over customer contracts. So our professional services organization was not really that focused on revenue. They were focused on getting jobs closed and their utilization and how many hours they were delivering. And those were their own internal metrics, and they were driven by customer satisfaction. And now they still have to focus on all of those things, but on top of that, now their activities directly affect the company's revenue. So we've had to work quite closely with professional services management to develop revenue targets, to develop reports that show progress against those targets, and then we've also had to make sure that they have a clear line of communication back to us if they think that they're not going to meet those targets in a particular month or quarter.
Gotcha. Thanks. And Tim, what are you seeing at client companies with regards to communication and sort of coordination?
Well, I think going through the early adoption process, which has been our most visibility, it's definitely been a coordinated effort. So the two things that I would say, and again, not making a specific plug for NetSuite, for example, but to the extent that you have a system that can track both the sales leads and gather the information that's going to go into developing your estimated selling price, it makes the process a lot easier. Our client base is typically earlier stage companies or private companies. So to the extent that they're gathering this information, it's a much larger effort than they had anticipated, and it takes a lot longer time. That said, the sales group working with their systems group and potentially some outside consultants to gather the data, and then how that impacts the revenue recognition policy. Again, a really coordinated effort. And I think the end result is good information in developing the policy. But I think even more than just coming up with a good accounting answer here, the real benefit to companies has been a lot more visibility in terms of impact of pricing your product and coordination from a sales on through. And so I think that's something we've seen a lot of.
Great. Now, it's a wonderful world, obviously, if you have an integrated system, and NetSuite clients have that. But what other systems and tools are people using to handle transactions under the new guidance? I could see maybe really small companies managing this in Excel, but that would probably get out of control pretty quick. What else do you see folks using?
No, that's a good question. So we have a large number of our clients, especially my practice, that are on QuickBooks. So to the extent that they're using a system that doesn't have the full functionality, such as something like NetSuite or some of the other programs out there, it's more using Salesforce or any other tracking system that you're using from a sales perspective. It could be Excel, or it could be something, like I said, a little bit more than that. And then using a tool such as Access or something similar to gather the data. Because really the key for 2011 or even 2010, to the extent the companies were a little proactive in the process, has been they've been gathering the information in the right way and separating the data so that it can be analyzed. So for example, if you're selling 3 elements, gathering the cost and the sales component of each of those and tracking it. Whereas if you were to go back to earlier periods, so 2009 or 2010, which you'd need to do some of the disclosures upon adoption, that information is not necessarily available in the form you'd like it, just because it wasn't the thought going into gathering that data. So using a tool, like I said, like an Access or something along those lines, to set your parameters and then input the data or gather the data from your existing system, that's been the bulk of the effort, and with good success, because I think, like I said, Access is a tool that a lot of our clients have used, but I know there are several out there that allow you to manipulate the data and then set something moving forward. Because again, as you're developing your estimated selling price and then moving it forward, you're gonna be changing based on the changes to your business. I think that's equally important to keep in mind.
And by Access, do you mean Microsoft Access, the database management tool?
Yes, sorry about that.
Yes, okay, no worries. Okay, great. Well, thanks for that. So tell you what, we've got about 1 minute left. What I'd like to do is take care of a little housekeeping, answer a couple questions around that, and thank everyone for joining. So let's start with first a hearty thank you to Tim Parati of Frank Rimmerman and Eileen Tobias of NetSuite for their time and insight. Really appreciate the time for both of you. It's great that you both have so much experience on these fronts, and you did a great job in a short period of time getting all of that information through to the listeners, so thank you for that. We'd also like to thank Frank Rimmerman and NetSuite for sponsoring the event. It's great to be able to offer these events at no cost to our users at Performative, and thanks to both of those companies for making that possible. Certainly, we'd like to thank the audience for your time and attention this morning. I know everyone is incredibly busy these days, so taking any time out, even if it's for very practical education like we got this morning, is not easy to do, but thank you again for your time. As I noted earlier, if you have any questions about CPE credit, please send an email to Tanya Walsh. I've put it in the chat area on the GoToWebinar. Also, you can see her email at the bottom of the screen here. So please feel free to hit her up with any questions. She'll make sure you get taken care of. We will send a survey out. We'd like to know what we can do better the next time, so please let us know. Also, in that survey, we make it really easy. If you would like to be connected with either of today's speakers, we're happy to facilitate that. So just indicate that on the survey. It'll take you 2 seconds. And we will be posting this webinar out onto our website. It should be out there by Monday morning, and we will send everyone who attended an email with a link to get it. It's totally free to get it, so just feel free to come and grab it if you'd like it for future reference. With that said, I'd like to do one final thanks to everyone for attending today. Thanks again to our speakers and sponsors, and I wish everyone a wonderful Friday and a great weekend. Thanks all.